Adam, how are you?
I'm doing great. Thanks for having me on. Yeah, good to be here.
You and I were just chatting, and I just said, "All right, let's just stop because we got to hit record, and we got too much fun stuff that we want to capture on the airwaves here." So, why don't you just take us from the top, Adam? You've got a couple books, you've got a couple decade experience running companies, buying, selling, but take us from the top what you were just doing for me because I think that'll lay the groundwork, and we're gonna have plenty to cover over the next hour.
Sure, happy to, Ryan. Listen, so when I meet people for the first time, generally, I kind of tell them there's four things about my life that put me where I am today. First is service in the military. Served in the Army. Military taught me something about discipline, teamwork, leadership. Really great foundation to build a career on. I remember the tagline back in those days. I don't want to date myself too much, right? But back in the day, when Ronald Reagan was president, the tagline for the military was it was a great place to start. And from a career perspective, if I wasn't there, I'm not here, if that makes sense. So
Hmm.
military, I like to think, taught me a lot about teamwork, leadership, discipline. Number two, engineering. Always had a technical background as a kid, ham radio operator, building Heath kits, and just always following, and paying attention to the latest technology. In the military, I was working on classified air defense radar and missile systems, and that led me to a career in engineering. And I tell people engineering made me a meticulous planner. I'm also a pilot. You don't take off without knowing where you're going, what the winds, are like on the route, what
Hmm.
are your backup airports if you have problems. So you spend a lot of time on the ground before you ever get in a cockpit and take off and go into the air. Engineering, being a pilot, kind of led me to be a meticulous planner. What does that mean from a business perspective? I don't ever shoot from the hip. I could go off camera for like 5 seconds and I could show you two strategic plans. When I took over different companies, there's always a plan in place. Great recessions happen, pandemics happen. You always have to be flexible and adaptable. But at the same time, you generally, if you have a destination in mind and you have a charted course to get there, you're going to be more successful than someone who wakes up every morning and has no idea where they're headed.
Just
So
take the plane off, and we'll figure
that's
out where we
it.
land.
Yeah. So engineering, and being a pilot made me a meticulous planner. And then third, GE. So I was at GE during what I call the Camelot era, and so you kind of have to go back in time. This is before tech companies. This is before the internet really had permeated culture the way that it has today. GE was the world's most admired company. Jack Welch is at the helm. He was there for 20 years. I was there for the last 10. And, by that time, you earned the moniker Neutron Jack. A lot of the changes that were going on within GE happened kind of in that first 10 years that he was there. The second 10 years was all about growth. And it was all about, blowing out, targets. And it was a really special place. The 10 years I was there, stock split every 2.5 years. And I
Crazy.
thought as a young guy, stock split every 2.5 years, money rained from the sky. Hey, isn't this a great place to be? And so GE, I credit with teaching me how to run a business. I started as an engineer. I crossed over into management. I did the GE Crotonville leadership experience, learned from the world's most admired companies, business leaders, how to run a business. I became a turnaround guy within GE. And so I credit GE with giving me the business acumen and skills to go with the meticulous planning, with the discipline and leadership. You put all that together, and then that prepared me for the fourth thing, which is 21 years. For 21 years, I have been a president and CEO, working with 8 different private equity sponsors, building 3 different platform companies. And talk about experience, boy, as a guy in my 30s, being a CEO first time, building a business, boy, you make every mistake in the world, right? So 21 years of experience taught me a lot, and
Hmm.
I've had many exits during that time period. I think my worst exit was a 2x multiple of invested capital. My best was 9 times. Kind of my career batting average, if you will, is 4.5.
Hmm.
And it's been a great ride. If you look at those 3 companies, One was a medical services company. It was grown. It was sold to Berkshire, became a division of Aramark. Next one was a commercial laundry company. Went from family owned and operated to billion-dollar business. Went from a 0% market share in Canada to 90% market share in
Wow.
Canada. Number one in Canada by a long margin. Number two in the U.S. But billion-dollar enterprise. And then the third one was an HVAC and commercial refrigeration company. And again, these were buy-in builds. I was doing mergers and acquisitions. I bought 34 companies. When I was building one, I bought 23 when we were building another. Two of them hit billion-dollar valuations. And so it's 21 years of experience kind of doing the private equity thing. And to tell the truth, when I started, I didn't know what private equity was. I was
Yeah.
chasing money and title. First chance to be a president. First chance to get some serious potential ownership and stock action. And I didn't know what private equity was at the time. That wasn't what was motivating me. It was money and title. And
Hmm.
so learned a lot over the last 21 years as private equity has grown
Yeah, no
from,
kidding.
21 years ago. There were fewer than 1,000 private equity firms, and there was, you could measure assets under management in the hundreds of billions. But you roll tape forward 21 years, there's 6,000 PE firms,
Isn't that
and
crazy?
there is over 5 trillion in assets under management. There's 1.5 trillion in committed capital right
Yeah,
this second while we're
not
talking,
spent.
looking to go buy stuff, looking for stuff to buy. PE has permeated every part of the business world at this point. And, this is going to be the first year in 2022 where more than 50% of all M&A activity on the planet is going to involve private equity on one side of the table or the other or both.
Isn't
And,
that
and so
crazy?
private equity has just exploded in the 21 years that I've been working with PE firms. So that's kind of my, world, where
Yeah.
I came from.
I love it, and we're gonna be able to unpack that. And so, Adam, there's a for the listeners in, I unpacked like all the deal structures and how private equity works in this podcast with Sonny Vanderbeck. He's got a conscious capitalism fund, and so we went through all of the structures between the general partners, the sponsors, the platforms, how it all works. So listeners can go check that out. And what I wanted to do is so that way we can kind of park over like the mechanics we've covered, but I want to go into like that experience that you had, like covering the ground of like what is the strategies behind private equity. So like, taking the different ventures that you have, like walking through, when you say 8 different sponsors, let's talk about like the sponsors, what that means, and then what was the strategy. Like, let's go back to the first original gig that you had. So what was the
Yeah.
pitch? What was the pitch to you? And then, using the military, the engineering, and the GE combo, what did you then build the plan for, and how did the private equity partnership impact your plan, and how did that like what did it look like?
Sure. So let's just let's start, from an entrepreneur's perspective. I look at private equity as a tool. So they look at me as a tool too. So,
Mhm. You as in like
you think,
as a CEO leader, right? Is that what you meant?
yeah. So
Yep.
if you think about each, each need, so a private equity firm is in the business of deploying capital, buying companies, investing in companies, and they're going to owe their limited partners, a return. And let's be honest. If they just put their money in a stock market fund, they're going to get about a 10% return on average over a 30-year period. That's kind of what the
Mhm.
market's been doing. And it's you got to do a whole hell of a lot better than that if you're a private equity firm and you want people to keep giving you capital. And so
And locking
generally,
it in,
I'm sorry, go ahead.
and locking it up for a period of time, right? It's your liquid.
You're locking it up for 10 years. People, minimum investment about 5 million. The fund life is about 10 years. You could go as long as 12 years without any liquidity. You're committing the capital. You're sending money as they're buying companies. And at the end of the day, it's like, you got to do a whole lot better than that 10% kind of average return because you have no liquidity. And the
Mhm.
expectation is there's higher returns for no liquidity and time.
Mhm.
The major investors are, the limited partners are pension funds, they're university endowments, or very wealthy families that can tie up large amounts of capital for an extended period of time. And so a typical PE return profile is 3 to 4 times. You invest $1, you're looking for, $3 to $4 back in return, and so how do you do that? Well, private equity buys a company, I become a growth tool. I help them get the return they need to feed their limited partners to get them to invest more money in the next fund. And so, but I, as a guy building a company, oftentimes have multiple hold periods. So private equity shops are very disciplined. You have people who buy at this size and they take companies to this size. And then the
Mm-hmm.
next group of private equity guys come in and they go from this size to this size. And the inflection points are kind of like 0 to $15 million of EBITDA, 15 to 50, 50 to 100, 100, to 200, 250 and up, and
Mm-hmm.
that's the pyramid of private equity that you're climbing. So if you use one of my companies as an example, the laundry company, I ran it for 13 years, 4 months, couple days, maybe a few hours. And during that time period, I had 3 different sets of shareholders and they all came and went. What the constant was me and the leadership team, that was building this $1 billion company. And,
Mm-hmm.
and so I see private equity as a tool to help me navigate as I'm, building a company. They see me as a tool to hit a return threshold, and that's kind of the symbiotic relationship that creates, the private equity world. And if you take it from that perspective and you say, okay, what does private equity need to do to achieve their kind of style of returns? Well, typically you have to go into a company. Now, the biggest pool of capital in private equity is in the vertical called buyout funds. So these are private equity funds that buy companies. They become platforms, or call it the crown jewels of a specific fund, and then they're going to grow those businesses over a period of about 3 to 7 years during the 10-year life of the fund, and then they're going to sell them. So in order to hit the kind of returns, you need a 30% compound annual growth rate. Let's talk about that for just a second.
Yeah, I was gonna say I would go dive right in, man.
It's a big number, right?
Yeah.
So if you take all 3 companies that I built in 21 years, all of them had been in existence for 40 years prior to my arrival. So
Wow.
these are not startups. We're not talking venture capital where if you go from $1 of profit to $2 of profit, you had 100% growth.
Yeah, right.
We're talking about businesses that have been around for decades and they're in mature industries. And as a result, they're probably growing on average when I get there at about 6%, 4 to 6%. If you're lucky, 6 to 8%. But that's it. And think about 10%. In investing, there's this thing called the law of 72. If you are getting a 10% return, which is the stock market average over 30 years, it's going to take 7.2 years to double in size. Okay, that's a 2x multiple of invested capital. If you're a PE firm and you're doing 2x, you better be a multi-billion-dollar infrastructure fund that's buying toll roads, because if you're a buyout fund that's doing growth, you're out of business.
Mm-hmm.
You need a 4x return. At 4x, that's 30%. At 30% compound annual growth rate, a company doubles in size in 2.8 years, 2.7 years, something like that. And it triples in size, in 4 years, 4.2 years, and it'll get to quadruple the size in just over 5 years. And to do that, you're talking about taking a 40-year-old sleepy company that's going at 6 to 8%, and then boom,
Mm-hmm.
bending the curve, achieving and sustaining a 30% growth rate for 5 years or more, because you can't sell a company that's not growing. So it's got to hit that 30% ramp
And keep
and
going.
it's got to keep going, because
Mm-hmm.
when that private equity firm exits in 5 years, the next guy is going to want it to keep going at 30% for another 5 years.
Mm-hmm.
Now, that's really hard to do. And so I think that bending of the curve is where investments are either made or broken from a
Mm-hmm.
private equity and an entrepreneurial perspective. Founders transitioning to private equity just got a big payday, and they're like, "Woo, can I slow down now?" Hell no.
Exactly.
Now you gotta actually amp it up, take
You
it
just
up a couple of notches.
You just grabbed the rocket ship, man. And Adam, I want to interject here because you laid out the groundwork for the the investment thesis, like why these PE firms would want to do, well, need to do this because they raise the
Sure.
capital. And then I want to make a couple comments, and then I want to tie together your like the management roles and the alignment with management and the investors, and then the buyers that you're buying out too. But let's put a pin in that for a second, because a couple comments on when I think about, just you had mentioned some macro trends, and like you great overview on some of the big things, like the couple of $1 trillion that are sitting there waiting to be spent. And like when you think about why this is necessary, I think it's so important for the listeners because you can't get returns anywhere else. So like, you talk about Yale Endowment and their allocation from private equity over the last 20 years that you've been doing this, or anybody, it's like, we can't get yield anywhere else. So it's going here, which is driving all this activity. And I think that's so, and with that context that you gave of like, it's just math, man. Like these are investors that are
Yeah.
giving money to other people that want more money back. Really that simple. But when I think where I see it, Adam, and I'm curious along your journey. So you're the hired gun as a CEO that comes in for this first one, and you've got the mandate of like you said, the 30% compounded annual growth rate to get the money back to them. I see so many times people end up on the show with regrets because someone, like you said, just sold, they want to be done. And there was this big black box. So it was all of this misalignment of expectations after that, right? It was like, oh, here's my legacy, here's my baby. I didn't know we're going to have to grow like that or cut costs. So all of these things happened after the fact that I was not aware of, makes me upset, and whatever it is. Or there's all these alignments of the company and what the owner wants, their involvement and need, and then what the actual mandates are. I don't know, speak to that. Like when you're talking about buying, you got all these companies you've bought. How do you align the mathematical needs of the fund and the PE firm with with the sellers, and then you as the driving force behind the entire plan?
So I first start with education, because what you just pointed out, is the reason I wrote 2 books and they were both number 1 bestsellers. It's private equity is a literal black box to most people. They've heard the term. They know a little bit about VC because they watch Shark Tank on TV and they kind of think that's cool. But venture capital is a small piece of the overall world of private equity. And frankly, most venture capital funds don't return better than a 2x, kind of multiple of invested capital. Everyone's looking for unicorns, and home runs. And that's a tough place to put your money to work. I leave that to these big endowments that are looking for the next Uber, or the next, absolute home run. They can afford to take those kind of risks. Common person, typically shouldn't be taking those kinds of risks. But when I look at it, kind of the world of private equity and how it's grown, we talked about this off camera. I think if I set up a little table, outside, I'm in Dallas. If I was at the DFW airport and every person that walked by that looked like a business person, if I had them take a basic 10-question quiz on private equity, I think the vast majority of people would fail, and they just don't understand the concepts. And so go back to your thesis and your question. You're an entrepreneur or a business owner, someone who's been running a company for a long period of time. You're getting all these phone calls from private equity because there's 1.5 trillion in cash capital committed, looking to buy something right now, this very second, while we're talking. And you're getting the calls. You don't really know what it is. You partner with it, and then there's a misalignment or a disconnect. And it's because people don't understand what the basics of private equity are, what it is, what it needs. And so the private equity playbook, when I wrote that, it's still, if you go on Amazon right now and look at it, it's like number 2 in a bunch of different business categories. It's 3.5 years old. It still hits number 1 in categories. Even private equity firms are ordering that book, in quantity to give to incoming associates or to give to entrepreneurial prospects, because it doesn't do anybody any good when there is that misalignment. You're so right that it's simple math and it's simple, investment, simple investment thesis. So the more an entrepreneur knows about what private equity is, and then what the needs are and what's going to happen to them on the journey, the better position they are to be successful. And I think right now, when you just happen upon entrepreneurs who sold businesses to private equity, half of them will say it was horrible, never work with them guys again. and the other half would say, "Oh, I had a good outcome. It was great. It was fun." And it's hit or miss because it's left to chance because people don't know what a good partner looks like or what their needs are or what their partner's needs are. And so you have, kind of a 50% hit or miss rate with people.
Oh, and I want to comment on that, Adam, because I think that concept applies for ESOPs, family transitions, partnership
Sure.
buyouts. Because, the whole point of the title of the podcast is intentional growth. Like, do it on purpose, right? And so many
Yes.
people are just like wake up and randomly like, oh, that might make sense, and then they let things unfold, and it's all just happenstance. And so, like, going back to with all these companies that you bought and sold, explain, like, maybe hypothetically, if I was a potential buyer, or no, I'm sorry, I was a potential seller, and you're having a
Yeah.
conversation with me, and you're sitting here going, okay, what was that process like, trying to understand that alignment?
Sure. So first of all, you're talking about alignment. So let's just define alignment real quick. The way
Yeah.
that I do it, when I'm doing a buy and build and I'm taking 20 some odd entrepreneurs who all, by the way, are successful multimillionaires because I made them multimillionaires by buying their companies, and these are folks who've never had a saddle on, they've never had a boss. And I say part of my role is I'm a den mother. I'm one of my superpowers is I got to take 23 very successful multimillionaires. Most of them are going to be decamillionaires because I just gave them 20, $30 million to buy their businesses. And now I got to get them all aligned on the same page, singing from the same hymnal, doing the same dance, over the next 5-year period. So what
And
I
their employees and cultures.
Sure. Right. So, yes, not easily done,
Yeah,
right?
easier said than done.
And boy, we could do another podcast on buy and build because buy and build is only successful when you spend a lot of time up front really focusing on knowing what good looks like and only buying good companies and putting good companies together with other good companies that culturally fit, that strategically fit, the thesis. And you know what? If you encounter the cowboy that you can't put a saddle on, walk
Yeah.
away.
Mhm.
Walk away because one bad deal. Ty Cobb was the best baseball player ever. He batted four something, which means 6 out of 10 times he struck out. When you're doing a buy and build, you got to bat 980, 990 or better. You can only afford to have one sideways acquisition out of 20 or 30 because it'll zap so much strength from your leadership team. Takes so long to fix, it's not worth it. But let's go back to alignment. So what I do is a portion of the sale includes a rollover investment in the parent company. And so by doing that, I hate earnouts, by the way. So
Oh,
earnouts,
wow.
I personally hate earnouts. Earnouts,
Mhm.
the joke, amongst PE guys is earnouts are a lawsuit waiting to happen. The only question is who's the plaintiff. So I never want to buy a company and then be out of alignment with it where their success may not be my success. It
Mhm.
needs to be our success. There is a time and place for earnouts. You can do them, especially when it's a platform or it's a new company in a new region, and there's not going to be other activity around it for a
I
period of
think it's
time.
just a comment on it. I think it's just it's refreshing coming from a private equity, person, because so many times, the earnout is used for ill intent. You know what I mean?
Sure.
And again, it depends. It's usually coming from the other side because they're convoluting the deal structure. And so, like, it was just refreshing. I just wanted to call it
Yeah.
out. Like,
So I
hey,
don't like
it's
earnouts.
good.
First of all, I've held every job you can hold in a service company for 35 years. I started my career, I drove a truck. I was on call. I worked nights, holidays, weekends. I was an engineer working on CAT scanners in hospitals. And that work happens 24 hours a day, mostly in the middle of the night on a bad winter night when you're driving across northern Michigan or something. So, in my world, alignment is key. So a part of the sale has to include a rollover. That rollover investment in the parent is then when all 23 entrepreneurs or all 30 entrepreneurs sell a business, get a payday, and a portion rolls forward, they're sticking around. I've done it where they stick around, I've done it where they don't. But when they're sticking around, I use that rollover investment because we're now all shareholders of one entity. And so shouldn't matter whether it's your success or your success, it's our collective success. And so, I call it the former owners alumni club. People would literally get jackets. It's kind of think of some club from 30 years ago where they gave you a membership certificate, some swag.
Mhm.
I would create kind of the former owners alumni club. These are people who were very successful entrepreneurs. Only 7% of all people who start a business ever hit a million in revenue. Only about 4% of those ever hit 10 million in revenue. To be people who've been paid 20 to 30 million dollars for businesses that they've built. These are all very successful people. And to align them, we become shareholders in the mothership, in the holding company, that is the strategic platform that's acquiring the businesses. And then I talk about the power of rollover investing, and I typically go back to one story. I'll call the guy John Doe. His really name, his real name is Sam. Hey, Sam, I'm sure you'll hear this. So I buy a company. That entrepreneur, I pay 16.4 million for that company. He rolls over 4.4 million forward into the mothership. That's his rollover investment. He takes 12 million home. Diversifies assets, still has enough skin in the game to make life interesting. Goes about his business running his company. I buy 7 more companies, put them together. We sell for a 4 times multiple of invested capital. Well, 4.4 times 4 equals 17.6. Well, the first time he sold his company, it was 16.4. Second bite of the apple was 17.6. My thesis in life is always to roll over enough so that the modeled return gives you a bigger second payday than the first.
Mhm.
So here's a guy who, if I told him, if you could take all 16.4 million home and not roll over anything, would you? Well, of course. I'm not running the company anymore. It's like
Yeah,
I want
yeah,
all my money
100%.
out.
Yeah,
It's like
yeah.
but I recognize that in order to get that, I had to roll over, and so I did. Well, what do you think of rollover now after you just got paid 17.6 million for what was 4.4 million rolled over, and you'd have been happy walking away, and taking 16.4 home, but now you got 29.6 million because you got 2 paydays minus the 4.4 million rollover. Now what do you think? Oh, this rollover crap is great, man. This is
Everybody should do it.
yeah, I'm gonna go buy a winery. See you later, Adam. But hey, I'm gonna roll over 5 million more for your next bite of the apple, and bring me another 4 times multiple invested capital. That one will be 20. That'll be bigger than the second, bigger than the first, and by God, all told, I'll be looking at, I don't even remember what the math was. It was like $59 million or $57 million, total. But it's like, hey, rollover investing. Here's what I tell entrepreneurs: you are working with the world's most sophisticated business people on the planet. And it's a professional sport played at the highest level. It pisses a lot of people off because of the intensity about it. But the fact remains that these are folks who historically beat the market by at least a 2x multiple, over an extended period of time, and as a result of that, you get to, as an entrepreneur, make an investment and kind of grab the coattails of these private equity dudes, and roll right along with them to get future paydays. And so I
And
tell
with that,
people, hey, this is the brilliant part of private equity done right. When you're an entrepreneur that understands how it works, what your role is, why you have to bend this growth curve, and when I'm at the helm, because I've been doing this for so long, I spend an inordinate amount of time making sure that the entrepreneurs that I work with understand the different facets of this,
mhm.
what the risks are, what the rewards are. And so generally speaking, I get credibility from, the blue collar guys in trucks who started businesses and became decamillionaires because I used to be one, and I've done the same. I've walked and chewed the same dirt they have,
Mhm.
different industries, but same similar story. And I've been doing this for so long and have such a long track record of it that it's easy to kind of buy into the thesis. And then as you're doing a buy and build, when you're buying 30 companies, well, the guy who's 21, he can talk to 20 people who came before him, or her, and they can understand what their own personal journey was like and kind of validate the reality. So,
Well,
you
and that, because that was great. And I want to continue pulling on the thread of alignment, because you did a great job of understanding how to align the capital needs and the growth needs of all the money, which I think, curious on your comments on this concept that I don't know if it's too simple, Adam, but like, okay, so when I think about like very, very successful entrepreneurs, they understand finance is like a Venn diagram for the people listening. And there's finance, and then there's operations, and then there's like the in between of the Venn diagram where you understand operations and finance.
Sure.
And that's truly because I watch like when I hear like the horror stories, it's a lot of spreadsheet junkies in private equity that have never actually ran a business, so they have no value add to the operators of the business, and it's more just cut your way to returns, which you and I both know is not possible. So going back to alignment, I'm curious on like because you can have alignment on the numbers, and also with those numbers, I've watched so many people with those projections. Like I could build projections that look awesome, but then it comes down to the operational
Yeah,
execution. So, and I know
absolutely.
you mentioned your military and then GE and some of these things. So, like, explain the alignment on the operations and then the vision of these businesses. Because let's say you were talking to me and I was that person, like, okay, fine, I'll roll 4. I'm going to sell for 12 for capital. Great, but now I'm not going to have a complete control of the operations. And in order to get that 4 times invested capital, you got to do your shit right, Adam. So, like,
Yes.
how are we going to align operationally and the strategic vision of the operations? How did you guys go about doing that?
Well, so I used to periodically, first of all, I think transparency is the way to do that. So as a CEO, always been very transparent. If I got 3,000 employees, all 3,000 employees know how much EBITDA we got, what our revenue is, and where we're going, and when I'm going to kick the current shareholders out and bring in the next set, and when I'm going to get to the next bite of the apple. A lot of entrepreneurs are secretive about these
Got
kinds
it.
of things. I'm not.
Got
And
it.
it's like the more I can educate the workforce, you know what? 3,000 guys in trucks may not have a clue what the hell EBITDA is, but by God, they know how much we got, and they know when I get to a certain level that we're going to sell, and bring in new shareholders, and they understand the difference between private companies and the need to have changes in control every 5 to 7 years versus a public company, which is bought and sold every day, on the stock
Hmm.
market. So liquidity versus non-liquidity. So I'm transparent as hell. I
Got it.
communicate, over communicate throughout the journey. I try to educate line employees, executives, and by the way, typically when you're working with a private equity firm, there is a pool of capital that's set aside to give incentive to, members of the leadership team, call it equity incentives to do a good job and hit those returns. Private equity, when things are working well, they're the most generous people on the planet, and they share that wealth freely with leadership teams. And so you're able to create generational wealth as an employee without ever having started a business, owned a business, run a business by being an executive. And that's why, in the first book, I target 2 groups of people. It's the founders and the transitioning owners, but it's also the mid-level to high-level, call it Fortune 500 executives who are being recruited to come out and run, a
Hmm.
private equity-backed adventure. So the more you understand private equity, the better off you are. And like anything in life, when there's 6,000 firms, there's good, there's bad, there's ugly, and there's
Hmm.
great. And so I think for me personally, I've learned so much over 21 years. If someone approaches me today and says, this is, come talk to me about being CEO, I'm going to do some industry research first. If you're going to do a buy and build, I need a fragmented industry. And so
Hmm.
here's a trick. Here's some private CEO magic, golden nugget. A lot of people listening to this podcast aren't probably going to be old enough to remember these things called phone books, but they used to exist. And there was
Like,
white
come on,
paper.
I was at a conference last week, Adam, where people were talking about party lines. So,
Okay. So I call it the phone book test. If you want to know if an industry is fragmented, go to a
oh yeah.
phone book in every city in the country and go to the yellow pages, look at A, B, C, pick your number. And if you see the same kind of companies listed,
Hmm.
let's say dry cleaners,
Hmm.
landscape, contractors, electricians, plumbers, HVAC guys, just pick anything in a phone book, insurance, agencies. If you don't see the same name brand, but you see different names in every phone book around the country, that's your clue that there's probably thousands of businesses in that industry doing the same thing. That fragmentation is the key magic to buy and build because when I'm buying 30, 40 companies, I'm buying small businesses that trade at a small multiple, and I'm
Hmm.
building a much larger business that's going to trade at a much larger multiple. And the arbitrage between what I buy at and what I sell at creates the capital or the profit, that drives the returns for the private equity guys. So, good classic example. I once ran an industry where I bought more than 20 companies. The average multiple I paid was 5 times. And so I'm paying 5 times EBITDA for 20 companies. Each one's 2 million in size, an average 2 million in EBITDA. I buy 40 million of EBITDA for 5 times, 4 times 5, 200. It's 200 million is what it costs. The banks would lend me up to 5 times debt leverage because my cash flow would service 5 times debt. And since I'm buying it 5 times, that means I spent $200 million of someone else's money to buy 20 companies, each with 2 million of EBITDA, each at 5 times. When I sell that business, I sold it for 13 times. 13 times 40 is 520 million. I have to pay the banks back 200 million in debt that I borrowed. And on zero invested capital, I had $320 million of shareholder profit. That is the magic of buy and build. And it's the arbitrage between buying and selling. And it requires fragmented industry. That's like number one.
Yeah, and I see this all the time now, and especially with the frothy marketplace. We got a client that just sold for about 60 million bucks. Just take hypothetically, let's say it was 6.5 million in EBITDA. They stacked it on top of 35 million in EBITDA from a private equity firm, and they sold the company, the whole portfolio, within 60 days. So
Sure.
they literally were owned by that PE firm only by 60 days. That's that perfect multiple arbitrage. And Adam, what I'm seeing as a potential freight train, and again, I might be way off on this, but is the beautiful math that you just described is why there's now 6,000 private equity firms and 2
Yes.
trillion in capital. What I'm seeing, and I'm curious on your comments on this, is that the beautiful math is not as easy anymore because you can't find good deals all the time that are at good valued price. Because I watch prices right now and I'm like, I would hate to be the PE firm that's paying that amount of money for that shit.
Yeah.
And then what the hell are they going to do? Because what you just did was straight line of 2 millions of EBITDA, millions of EBITDA on top of one is one. That's at 13 instead of a 5. But what I'm watching now is these spreadsheet junkies who are good at raising money and good at the storytelling that you just said. Like, hey, people, you paid 30% more than you should have. You don't
Yeah.
know shit about running a company. Now, what are you going to do? And you still owe 20% rate of return to your investors. So
You're bringing up the question of
did
private
I
equity.
hit a
And,
chord?
and and I got to tell you, every year people say the same thing, and every year more money keeps pouring in. So it's like it's a bubble that never bursts, but people talk about it all the time. So great observation. Let's talk a little bit about that. So multiples are really high right now. A company I ran that once traded for 8 times, then traded for 13 times, now trades for 20 times. Multiple arbitrage is built in. Used to be, if the market stayed flat, you would get step ups, in
Hmm.
multiple arbitrage at those inflection points,
That you
50
mentioned earlier.
million,
Yeah.
50 million, 100 million, and you would gain, 2 or 3 turns each time. But now, because of the competition and all the money chasing the same deal, prices have gone up. And so during the whole period, you're also getting multiple arbitrage on those, call it, different inflection points. And so the whole industry is kind of walking up while you're also doing buy and build and building arbitrage. And so it's beautiful. It's beautiful math when it works well. But what I see as the problem is that if you're paying too much for something, then either returns have to moderate or something has to change. And I call it active management. So when I was a CEO sitting on a bunch of boards, I can honestly tell you, and I'll tell it this way, that way no one knows which one I'm talking about. But of all the people who sat on my boards that were put there by private equity folks, only one person ever added any value to me as a shareholder or as a CEO,
Hmm.
building a business. And what I see is, I think they were really there for the limited partners, look, you're giving me a bunch of money. I got all these great folks who've got great titles and have great experiences, and they're watching over the hen house where we're putting all the money to work. You can sleep good at night. Give me more money for my next fund. But they're not adding any value to me. And so I call it active management, and the PE firm needs to put more hands on to that company early, but not in a negative way.
Right.
Someone like me who's either bringing a CEO coach mentality, or a mentorship mentality, or a buy and build mentality, or I know the industry, whatever the reasons are that I'm there. I want to work with that CEO, and instead of seeing him once a quarter, or talking on a phone once a month at a monthly review, and then the obligatory dinner, shake hand, kiss baby, 4-hour board meeting the next morning, and then run to the airport because, I got to catch my flight to go to the next board meeting. I'm talking to my CEOs every week. I am in person with them every month. And I'm also doing the check the box stuff the PE guys need quarterly, and what have you. But it takes a lot more teamwork and active, active help, not in a threatening way, not in a pain in the ass way. You talk about guys with spreadsheets. PE is famous for asking a million questions and driving, entrepreneurs insane because all they're doing is keep answering questions. I'm not running my business. I'm too busy giving you data, and so you got to feed the needs of private equity. And oftentimes that means that a sophisticated CFO or an FP&A effort has to be put together. But typically the way it works in private equity is if you're performing, you don't get help. Matter of fact, you get ignored because you're performing.
Right.
And it's when you're not performing, you get a million questions and you get help. And you don't want help if you're running the business with private equity guys. But a lot of it goes back to just the basic understanding of the time element of bending the curve, achieving a 30% growth rate early. And I think PE firms have been a little bit asleep at the switch, waiting too long to get out of the gates. And we need to be faster out of the gates, be focused on that inflection point immediately. Do we have the right people on the bus? Boy,
how about
last
the
time I was looking,
how about the operational strategy, Adam? Because I think about the old private equity strategy. I mean, I don't know if you've probably read King of Capital. I love that book. It's just amazing, but it's outlining the whole.
Mine's better. No, I'm joking.
Yours is a playbook. Theirs is like, oh wait, how did Blackstone actually get to be? And I can't. It's a little. I'm going to digress for a second. Oh my God, would I have loved to have been them back in the day when it was just like shooting fish in a barrel? I mean, oh my God. But the old thesis of just the financial modeling and the capital modeling. I think to your point of integrating the operational model and the active management, what was your
you got
thesis?
3 levers. There are only 3 levers. Now someone's going to immediately put a comment somewhere down here and say, no, Adam, there's 50,000 levers. Okay, but there's 3 major buckets. When you think about a company, again, go back to the beginning, these companies been in business for 40 years, right? So they're old, mature, growing at a slow pace. You got to get to 30% because that's the math. Just get out a calculator and go 1 times 1.3 times 1.3 times 1.3. You're looking for a 4x multiple. So if nothing else changes in the multiple arbitration or escalation, you got to hit 30% growth for 5 years, to get to 4x multiple of earnings. So you got 3 levers. I got growth, organic growth. No, we're not talking about organic. We're not talking marijuana here. We're talking organic growth. We're talking sell more of the stuff that the company is either product or service, that they're providing. Sell more. Or sell more, sell the same amount at a higher price, et cetera. It's like there's levers within each. There's price, there's quantity, and so organic growth. Normally, so I'm looking for a 30% growth recipe in a business. Generally speaking, I can get organic growth to as high as maybe 12%, but probably more probable it's going to be 8, 9, 10% organically. How am I going to do that? Strategic pivots. Maybe I'm going to tier my products and services. Think of Mercedes-Benz. You got a lot of money. They sell you an S class. What's S? Expensive. It's expensive Mercedes, right? And then if you can't afford the expensive one, they got an E class. What's the E? It's the economy version of the expensive Mercedes. And then if you just want Mercedes cachet, but you don't have any money, they sell you the C class. What's that? That's cheap. That's the cheap Mercedes. You can get one for 30 grand on the right time of month at the right time of year, all stripped down. So, people tier products and services, FedEx on a service business, they first originally started, it was next business day, 10:30. And then it was next afternoon, 2 day. Oh, hey, we got this 8:30 a.m. thing. Well, guess what? All of those packages are moving on the same damn truck, on the same airplane, at the same speed. They're just slowing down when you're getting it and charging you more for it when you get it quicker. So tiering products and services, making strategic pivots to find blue ocean or new
Mm-hmm.
markets to sell into. You can do a lot of different things, but generally speaking, organic growth is one component. It includes price, and you're looking to get it as high as you can. Once you do that, the next bucket is expense. It's margin. What we're talking about is a 30% growth, not in top line revenue. Private equity care less about what's going on at the top. It's
Amen.
30% growth at the EBITDA line, right? So EBITDA, includes, if you save $1 in cost, that's $1 of more profit, at the EBITDA line. So margin improvement. This, for me, this is redesign process. If I go into a business that's mature, a service business, I start asking why. Why do we do the crazy stuff we do? Oftentimes, it's a process that's been in place for 20 years, and someone says, if it ain't broke, don't fix it. And I say, just because it isn't broke doesn't mean it's efficient. Let's process map everything that we do. Let's find bottlenecks. Let's solve for bottlenecks. Often for me, it means let's invest in technology to make workers more productive. And that laundry company I ran, I had a 42% increase in employee productivity. You
Holy
take a
buckets.
42% increase in employee productivity from the top line to the EBITDA line, that's
Wow.
millions, tens of millions of dollars in increased EBITDA. So margin improvement is a piece, organic growth is a piece. And if you can't get to 30% and hold it with those two, then the third lever is buy and build. There's got to be some merger acquisition activity to get you to that 30% compound annual growth rate. Little secret, Wall Street doesn't give a damn whether you're growing at 30% because of mergers and acquisitions or because it's organic and it's margin improvement. You do have to have all three, though. You can't be a one-trick pony that's just growing because you're buying stuff, because at some
Mm-hmm.
point
Mm-hmm.
industries consolidate fully. And when they do, if you don't have an organic growth story, you're in trouble. So
Mm-hmm.
there's a balance between all three of those components. But if you can improve, your margins while you're increasing your sales, making strategic pivots, tiering products and services, getting a little more price, upselling, McDonald's, would you like a large fry, with that? Is that a supersize? Whatever. At Burger King, it's like, everybody has the gimmick, but that's what they're doing. They're
Yep.
they're
Yep.
they're they're increasing the volume and getting more price. So it's organic, it's margin improvement, and then you've got sprinkle it in with mergers and acquisitions or buy and build. In totality, 30% growth rate. Got to hit it early because PE guys are paying too much,
Mm-hmm.
and,
Mm-hmm.
and they got to get instant ramp up. Here's an interesting thing. Last time I was running a company and I had sold it, we were retooling for the next hold period. We did kind of an evaluation. What are the 5 or 6 strategic things we're going to be focused on to add this kind of growth rate and sustain it, from this point to this point? And kind of identified the top 20, 25 people in the business that were going to be focused on that. Because as a CEO, that's where I'm going to spend my time, is with
Mm-hmm.
those 20 to 25 people. And guess what? In this particular case, after I just had a successful run, we identified that 9 of the 20 positions were new. They were new
Oh.
jobs that didn't exist in the last hold period, where we just got a 4 times multiple of invested capital. Because the company had grown so much, we now had new needs in order to continue that growth
Mm-hmm.
trajectory. And so sometimes it's not what you have, it's what you don't have that makes the
Mm-hmm.
difference between, sustaining that 30% growth or missing it. And so I would say PE firms need to be more active at managing. And that doesn't mean be more annoying. That means be a true partner to
Yeah.
management and get them the help they need on their side. The foot soldiers are going to help them be successful. Get there early, get on that trajectory early, and monitor and sustain it.
How did you take that framework and then identify good targets to buy and build or bolt on. And two parts to that question, Adam. One is maybe it's more like how you handled the kind of different components, right? I kind of see it as you might find a good business target that works with your thesis, and the entrepreneur is a psychopath or got, whatever,
Yeah.
whatever craziness that we all come with, or just a lack of education, or then the opposite of a good strategy in entrepreneur, but maybe not that great of a business. How did you go through and like just judge whether it was worth your time and due diligence,
Yeah.
or having those
So
conversations?
when you're doing a buy and build, the most important thing you do up front before you ever talk to anybody is identify what good looks like. When you're a leadership team who's never done buy or build before, you start chasing shiny pennies. Every business you look at looks good. You see only the upside, you never see the risk or the downside. It starts with strategy. What are we trying to accomplish in a buy and build? So for me, it's usually one of three strategies. I'm extending the geographic reach of the company I'm running. So maybe I started with a regional company and I want to build a national company. I'm building density in my existing markets because I'm a service business. Having more stuff to service in a small geography is it's more efficient, more
Hmm.
profitable, than chasing your trucks driving halfway across the state to get to their next service call. So density is important. And then third, creating those strategic pivots to find new addressable markets or so an example I'll use, when I got to the refrigeration service company, it was doing about 90% refrigeration in grocery stores. Great. It's been doing it for 40 years. It's good business. However, it's 90%, it's a $4 billion addressable market. Well, let's do a couple strategic pivots. Let's add an HVAC arm because that takes the addressable market to 20 billion, and there's thousands of those. And so it opens up a new avenue of growth, both organically and also from a buy and build perspective. And it raises addressable market. Let's do another strategic pivot. Let's add professional services on top of that, engineering, and energy optimization. Because for my customers, what they spend in electricity is their single largest cost of doing
Hmm.
business. If you own a grocery store, you spend more on electricity than you do on people, because keeping food cold 365 days a year, 24 hours a day is an expensive gig, so being energy efficient. And, today you walk down the aisle at Target and the cases are turning on as you're walking. And as you look back, they're turning off as you're walking, as you're passing, and so it's all of these different things to try to save energy costs. And so, it's making my strategic pivots, doing the Mercedes Benz, or FedEx, kind of routines. And then it's identifying what's my strategy. And then it's putting science together around what does good look like. Well,
Hmm.
maybe I have an EBITDA percent target. I'm at 10%. I don't want to buy anything below 10% because it's going to drag down. It's not accretive. I want to buy stuff that's 12 to 15% or 17% because that rising tide's going to lift all boats. You mentioned personality of entrepreneur. Boy, there's two different ways to do a buy and build. There's buy and builds where the entrepreneurs stay, and there's buy and builds where entrepreneurs go. What's the difference? Well, if you have a scalable platform as a company, then the infrastructure that the entrepreneur brings, probably isn't important. However, how the industry contracts is important. If it's relationship selling, if it's short-term contracts, if people are doing business with you because as an entrepreneur, you were a man of your word, a lady of your word, and they were great, partners, and there's a relationship there that goes back to high school. I need that entrepreneur to stay because if they go, I'm going to lose the business.
Hmm.
So personality plays a role. And I got to tell you that there's a lot of times, Ryan, where if I'm looking at a company, I may like the company and I think of the entrepreneur's personality and I think, I'm not going to put a saddle on that guy. He's not going to join our team. He's not going to work with the other entrepreneurs, or be a good
Hmm.
fit. Walk away, run.
Hmm.
These aren't the droids you're looking for.
Yeah. Well,
Yeah.
and Adam, what's so awesome about the conversations that you've been laying down here is that, so like in our training in the private, in the option or excuse me, exit options is principle number 3 out of the 5 intentional growth principles. We walk through all the different ways to exit. It's literally this alignment, complete alignment discussion. We're like, in the private equity section, we're like, here are all the questions. And it's the same thing like with your playbook. Like, it's like, if the owners know what the hell they want and why from their money and from the vision of the business, all this stuff, they can at least align it with yours. Like, do these two puzzle pieces fit? And like,
Right.
what's awesome about, again, you've been so open about all these things. And I can only imagine it sounds like you were like that along the way of buying these companies, is so often the private equity firms that are out trying to buy want it to be the black box. So that way they can, make these moves, get the buy, and then figure out how to deal with the calamity afterwards. But like what we've always suggested is be unbelievably clear with what the seller wants, and then have the PE firm lay it all out like you've done on this episode, right? Like, so few people do that, where if it was just quickly done, then the owner can say, well, I could see myself fitting into that environment. Like right now, I can only imagine, Adam, with people listening in, a chunk of people are going to go, ooh, that sounds like a very interesting environment that I would like to work in. Or it could be my next stage. I could see a chunk going, you're never going to put a saddle on me, and that's not my right approach. But at least it's a good open discussion, right? And like the faster people can build that trust and get that clarity, I think it's trying to align the capital needs and the business needs and the personality needs all at the same time.
Yeah, and so you mentioned the desire to be a black box. Keep in mind, I mean, the 6,000 firms got a lot of money to put to work, and so they need to get the first deal. And they may be thinking, boy, if it doesn't work, I can bring in a new management team, or I can bring someone in that does get it and then work with them. But got to get the first deal, so I don't want to add an additional hurdle that someone needs to clear, that could prevent me from getting the deal. So there may be some of that goes on, but again, most of the private equity firms that I've worked with are filled with really good people, and they do care about employees, and they care about the businesses that they buy, and they want to be good stewards. Especially today, ESG has become such a huge component of limited partners' concern when they're putting capital to work. They want to make sure they're investing it with people who are being good stewards, from an ESG perspective, from a DEI perspective, and they want to be good stewards to employees, and so most of the people I work with, I would say, fall in the category of these are good people who want to be successful. They're going to share success with you, but there are a lot of sharks out there, for lack of a better word.
It's the same thing with, I just like using the example of realtors or business brokers or investment bankers. You're going to have the top echelon of the skills, and then you're going to have kind of everybody else in different spectrum of them. I just think that, like, because of how easy it is to start a PE firm these days, I mean, you and I could go raise a couple, some money right now and start a firm. And here's what I say.
Hey, we should, Ryan. Why aren't we? I got people calling me, offering me like $500 million to start an Adam Coffey Fund One, and I'm like, yeah, okay.
Well, and I think it's so funny because, like, when we're in our training, it's like, if you've seen one PE firm, you've seen one, because everybody brings their different approach, which is the entire point that you were just making. Is there's a lot of good actors, a lot of bad actors, but you've only seen one if you've seen one. And in knowing what the sellers want and understanding how the PE firm operates and what their goals are, it's just goal alignment. And you get lower towards the end of the bottom of the market, that are the PE firms that are now trying to roll up $500,000 EBITDA companies. And that's where you're getting into like real operational, what people need to operate. It just, you start to get lower, and then all of a sudden it gets a little bit less sophisticated. And the amount of people I've said, it's easier to work with knowledgeable people, period. Knowledgeable and experienced people, because then we can sit here and we're playing the same game. We're not arguing, are we playing checkers or chess?
Yeah. It's so going back to a buy and build, it's like, what, buy good companies. You find it, don't buy fixer uppers. That's not where you want to spend your time. If you're buying 20 or 30 companies, I've seen, buy and builds get derailed because of one bad choice, one bad shiny penny. So know what good looks like up front. You're right. Not all PE firms are created equal. And you're going to find, in any industry with 6,000 companies, you're going to find the good, bad, and the ugly, right? Think of house remodels. Some people do a great job and some people don't. Some people take your deposit check and they ride off into the sunset. And so it's, there are the gambit in any industry with 6,000 people in it. But generally speaking, I'd say, I put some of that back on the entrepreneurs, the founders, the people who are transitioning. You got to do your homework. You don't wake up one day and say, okay, it's time to sell. I'm going to sell. And the first private equity guy that gives me the most amount of money, that's my partner. That's not how life should work. you need to do your homework and your research, as a business owner before you take this kind of adventure and start a journey like that. And when they don't put the time up front, that's where as you said, you have an experience set of one. It was either good or bad, and it was based on dumb luck because you didn't do the homework. And
Amen. Hey, you almost dropped the mic on that last comment. And as we're wrapping up here, Adam, what gets you so excited about this? I mean, you've got a ton of passion. You've been doing this for a long time. Like, why do you get so excited to wake up and do it every day?
Well, I recently made a transition and a pivot. So, it was funny when I was younger, you couldn't get me to stay in a classroom. When I got older, it's like the most rewarding work I do has been speaking to executive MBA classes, at UCLA and Pepperdine and places like that. And, it's really rewarding to me to work with multiple companies at a time. So after 21 years as a CEO, I told the world I'm no longer a CEO. And of course, that's when CEO jobs come out of the sky. Oh, come on. Yeah, you can do one more ride, right? It's like it was never about working less. For me, it was a pivot. I'm convinced that I can work with multiple companies at a time, as that active board member, as a coach, as an advisor, and really make a difference so that more of those people who make that choice, to partner with private equity or work with private equity or sell a business, make it from a position of strength and from a level playing field where, they get the best advice of someone who's been buying and selling companies for 21 years, and I help them think through all those myriad of business decisions that have to be made. I help them get the right advisors, and you hire the investment bankers, the accountants, the lawyers, all the professionals that actually execute transactions. And then on the private equity side, it's taken 21 years worth of experience, but being the coach mentor to the founders so that there's a higher chance and probability of success because they paid too much for the company to begin with and they got to get out of the gates fast. And so I'm working with PE groups, I'm working with portfolio companies, I'm working with founders, but I'm working with multiple companies at a time. So what excites me in the morning, that's the fun part of what I do. And what I wasn't enjoying anymore was the minutia of being a CEO, and all of the stuff that goes with that. But I love the strategic part and the working with people and helping them think through complex issues and problems and developing strategy and then executing strategy. That's what gets me up in the morning, gets me excited. It's people. It's never the business. People say, how the hell can you be passionate about a laundry company? Well, you can't. Everybody on the planet has to do laundry. Nobody likes doing laundry. I'm passionate about the employees. I'm
That's
passionate
awesome.
about what we're doing and the journey that we're on, as we're growing our business and taking care of employees and building cultures. You can find a lot of things to be passionate about in any business. And if you don't have passion, you need something else to do. Because, you have to be able to articulate a vision, a shared vision, and you got to have passion about it. And if you don't have passion, your people aren't going to have passion. We were talking about a mutual friend of ours, that you ran into. Talk about passion and energy. Tommy Mello, shout out wherever you are in Phoenix. It's like, you got to have passion for what you're doing. Tommy's building the garage door company. Well, that's not sexy either, but boy, does he got passion for it. So,
And that is a truth, truth
it's all
statement right
about
there.
people and passion.
Adam, this has been an absolute blast. So, two final questions. One is because you're just talking about some of the things you're doing right now. Where can everybody reach you?
So LinkedIn, Adam Coffey, Coffey, just do a search, you'll find me. If you go to Amazon and type in Adam Coffey, you'll find my books. I have a website. You can go to adamecoffey.com, or you can go to my company, my consulting business is called CEO Advisory Guru. So CEOadvisoryguru.com, will also get you to me. I love hearing from people. I wrote my books. I'm hearing from people all over the globe. I've spent a lot of time, made a lot of friends, and it's been fun. So feel free to reach out.
That's awesome, Adam. And then the last question is, I'd like to hear what people's definition of the word intentional is. It's the name of the show, become a very important word for me and our business and the people we're working with. So when you hear the word intentional, what does it mean to you?
With purpose, purposeful. When I'm being intentional, I'm doing something for a specific reason to derive a specific outcome. And again, I'll go back to our very beginning. I'm a strategic planner. The reason I get where I want to be is because I know where I'm going. You know, I know
I
where I'm
love it.
going before, I've taught this before. It's like you get in a car, you tell somebody to drive, and you don't tell them where, and they're going to drive around in circles. That's what most people do in life is they live their life going in circles. But if I tell you get in a car and go to New York, now you got a plan. I'm going to be gone for multiple days. I'm going to need to stop in between, or I'm going to need to supply a Red Bull if I'm going to go straight through, and someone's got to feed the cat, and water the plants. And when I'm gone and get the mail, it's like, if you know where you're going in life, you can chart a course and you can get there. So to me, intentional is with purpose. It's purposeful.
I'm going to bottle that one up. That was perfect, Adam. Hey, thank you so much for coming on the show. This has been a blast.
Nice to see you, Ryan. Thanks. And I hope all your visitors and listeners had a good time. Talk soon.